Hello everyone, welcome to Market Index Technical Analysis Insights. I'm Carl Capolingua, and today's topic is the uranium price and ASX and international uranium stocks. Let's dive in. First up on the agenda today, we're going to look at the uranium price and ask, is the pullback complete? Uranium prices have been in a downtrend since January. They've spiked up recently, and we're going to see if there's any legs to that last uptick. Then we'll look at various uranium stocks and ETFs, kicking off with ASX, moving to some of the big global players and finishing off with a look at some of those major ETFs. And then I'll show you how you can keep up with my technical analysis that I publish on Market Index across my various feature articles and of course through my socials. But before we get started, the technical analysis warning and disclaimer. This presentation contains technical analysis only. We're going to study the demand-supply dynamics for uranium as well as several uranium stocks with absolutely no regard for the fundamentals. Now, I'm sure there are plenty of fundamental resources out there for you to check out all over the internet, and I invite you to do so. But technical analysts like me believe that all available fundamental information is already embedded in the price, and therefore the price is all we need. So on that basis, let's dive in. First up, we're going to have a look at the uranium price, and to get an understanding of what's going on, we're going to use the uranium futures contract on COMEX, and it is the front month back adjusted. We're going to head to my trading view screen for this, and you can see here I'm starting with quite a zoomed out look at the uranium price, starting really from the Fukushima nuclear power plant disaster that occurred after the tsunami in Japan all the way back in 2011. Uranium prices took a significant turn for the worse after that incident, and you can see here using my trend ribbons, the dark pink represents the long-term trend, and you can see the light pink there just underneath it, the short-term trend, and it's pretty simple. A market that is in a state of excess supply at some stage is going to trigger the short-term downtrend first, and then eventually the long-term downtrend, and really it's only until you get some sort of equilibrium between demand and supply that we're going to move back into those amber zones, those neutral zones, and potentially then into the green, dark green and light green zones. So light green for short term, dark green for long term, to indicate that we have an environment of excess demand. The current bull market, that's what we're talking about, started all the way back here. I'm going to put to you in 2020, just after the outbreak of the COVID pandemic. It was a time where many major uranium projects globally had been mothballed, that is, put into care and maintenance because of the low uranium price. Uranium prices bottomed out around about 24, you can see there, dollars US a pound, and it was just uneconomic to pull that uranium out of the ground and try to sell it. Often what happens when you have multi-year, prolonged periods of downward price movement, you get significant underinvestment as well in the sector. So not only are you shutting down existing production, but you're not investing in that next round of production to potentially come out and supply the market. And it creates a tinderbox potentially for price appreciation if there is a catalyst to spark it. And that catalyst happened to be, in this case, the pandemic and, of course, the subsequent supply chain shortages and chaos that created. And often, that spark can grow and grow. And I always say that nothing makes the price go up more than the price going up more, because it creates this FOMO and often just the momentum that drags in technical traders like me as well can play a significant role. You'll see this occurring because we'll go double green, and you can see periods there where double greens didn't last for long, and that's absolutely possible. But by trading in this double green environment, I say that we're just giving ourselves the best opportunity for success. It's a very broad brush with my trend ribbons, and then we're going to use things like price action and in particular candles to really pinpoint our trading entries. So just starting off here with the broad strokes, as I say, to look at the overall trend, and we're going to fast forward now really to what's been happening since January this year. So we can see down the bottom there, if you're looking at the time scale, around about January this year, prices peaked pretty close to US 110 a pound, falling sharply initially, and that's usually a pretty good sign that the bull market over is probably too strong a word, but we're going to at least move into more of an equilibrium market, that really sharp sort of A-shaped decline, especially if you can't recover very quickly and recover, at least half of the decline. Didn't happen here. We got a little bit of a dead cat bounce. Now I'm going to zoom in just to give us greater detail on what's been happening more recently since that January peak. And you can see here initially the short-term trend ribbon neutralizes, telling us not that we're at the end of this incredible bull market, but simply that we're losing some of that upside momentum in the short term. We're moving into more of a balance between demand and supply in the market. The other thing you're going to see, and I said we get these finer details from our price action, and that is the relative positioning of our peaks and troughs, and we start to move into a lower peaks and lower troughs environment. And the only way, when you think about it, you can get a lower peak forming is if supply is building in the system, and or could be also demand is diminishing. And then if you start to take out your troughs, I always say that is you're removing the demand in the system, and clearly there wasn't enough demand to make that higher trough the next time. So lower peaks, lower troughs, a great representation of supply reinforcement and demand removal, and that is consistent with a supply-side market. The long-term trend, it makes sense. I've programmed it this way. It will take longer to change, and it's really only after a prolonged period of short-term sideways price movement that the long-term trend then begins to neutralise. I do say that when the price moves below the long-term trend ribbon, it doesn't have to turn dark pink. I know there is a traffic light system in operation here, so obviously green, double green is the best place to be if you're going long. You don't want to muck around with amber, and double pink is the best place to be going short. But we can make these more sensitive using this concept of dynamic demand and supply, in that if the price does move below the long-term trend ribbon, this is my experience, and then fails to reclaim that trend ribbon, so we start to make indications of that supply reinforcement through lower peaks beneath the trend ribbon. You can see an example here, and then a little bit later on through here, where that trend ribbon is now beginning to act not as dynamic demand as it did all the way up, but as dynamic supply. That is your trigger to say that we're in a long-term downtrend. So as I said, just repeating, we don't need to see the dark pink in the long-term downtrend ribbon to call a long-term downtrend, merely that it is starting to act as dynamic supply. And it is. Around here, you can go check some of my market index articles, my ChartWatch articles. I actually called just after that peak that the long-term trend in uranium had changed to down. Obviously, before that, I'd called that it neutralized, and then I reiterated that call here as well. So as far as I'm concerned, it's long-term downtrend sort of stuff for uranium. Hey, I don't know where it's going next. That's not what my brand of technical analysis is about. It is not about prognosticating. It's about only seeing what's there. So for me, it's just about probabilities. I'll trade in the direction that has the greatest probability, and for now, I can therefore not advocate longs. Certainly, you can do whatever you want to do, but I can't advocate longs for myself based upon what we're seeing here. So it really does demonstrate how little regard I have for the fundamentals, and I'm sure many of you listening today would get quite upset by me saying that and tell me all of the fundamentals that are very important for the uranium market. But I put to you, potentially, when you look at a chart like this, it makes it so much simpler, and none of that really matters. All that matters is what the actual participants in the market are doing and how they're voting with their cash and with their supply. Okay, the reason why I'm doing this video is this last little uptick here, and that's occurred, dare I say, by a combination of two key fundamental factors, and this is the only mentioning of fundamentals I'll give you, but it does explain this last little rally after the US election. We have had a very supportive bunch of rhetoric from President-elect Trump about building more nuclear reactors, particularly those small modular reactors. And then on Friday last week, we had the Russian export ban on enriched uranium products to the US, and that has caused a little bit of a price spike. But again, you can see that the long-term trend ribbon is just like clockwork. It is again impeding that upward price action, and prices have actually come down quite quickly from there. So for me, I'm going to go status quo here on my original call there. We are still in a long-term downtrend for the uranium price. what can change that? For the uranium bulls, what do you need to see to start to get that growing confidence that you're on the right side of the market again? I'd at least need to see us close above that long-term downtrend ribbon. That's going to be sort of an 84 to 84.50 close. Then we need to see that long-term trend ribbon is acting as dynamic demand again. So at least a trough above it, preferably a couple, just to demonstrate that it is now an area where the price is bouncing off. So rising peaks, rising troughs, closing above that long-term trend ribbon is certainly a minimum for me. And again, stay tuned to my market index analysis and you will literally see when I make that call. Okay, moving on to uranium stocks and ETFs now. We're going to review the charts of Australian uranium stocks first, starting with Paladin, then Silex Systems, Boss Energy, Deep Yellow, Bannerman, Lotus, Peninsula, Alligator Energy, Aura Energy, and finishing off with Elevate Uranium. Then we're going to move to three of the major global producers in Kazatomprom, Cameco, and Nexgen Energy. And we'll finish off with looking at the various uranium ETFs there, including the Sprott Uranium Miners ETF. The first ASX uranium stock we're going to look at today is Paladin Energy. And I think the first thing we notice here, of course, is that we are in a long-term downtrend. Okay, we are neutral there on the trend ribbon, but we're trading beneath that trend ribbon with lower peaks, and we're in a short-term downtrend as well. So very broad strokes, straight off the bat, it's very unlikely that I would be looking for longs on an opportunity like this. And don't forget, these are just charts to me. They're not companies, they're three-letter codes. I don't care what they're doing. I know that's blasphemy for many of you, but all I care about is the balance between demand and supply. And I believe that if a stock is fantastic, there will be a wall of cash trying to buy that stock, and the owners of that stock will be holding on, and they will only get out if they're compensated by a higher price. We're not seeing that. We're seeing very, very loose supply. Plenty of supply in the market. How do I know there's plenty of supply in the market? Well, look at the trends, look at the candles, look at this huge gap. The gap tells you that shareholders were desperate. They were desperate to supply, desperate to get out. And at the same time, there was a complete demand vacuum. And that's the only conclusion you can draw. There were just no buyers. There was just a complete absence of demand for about $1.50 until you got down to these low sixes. Look, to be fair, a little bit of a rally since then. We have had a significant volume event in that, volume significantly greater than average. And that does tell me we have had a degree of short covering potentially, and or maybe even some speculative buying here. But if we look at the progress that demand has made into the market, it really hasn't pushed the price up very far in relation to how far it has fallen. We're doing a little bit of a gap fill here, but the gap itself can often create a substantial amount of latent supply because we've just got so many shareholders now just stuck on the wrong side of the market, and many of them are just looking for a better price to get out. And for that reason, we often see that the short-term trend ribbon is a place of dynamic supply or excess supply where the price can hit and then bounce down. So potentially, that's kind of kicking in, or by the time it gets down here, probably like an 880. Maybe even a little bit lower, 870 by the time we get there. And I'd be watching the candles there very closely. So if I saw the supply side candles, that is the black candles, black bodies, and or upward pointing shadows. So shadows that point up are really pointing to where the price appreciation couldn't be held. Why couldn't it be held there? Because supply came into the market, often surprised the demand side. And you can see that definitely create areas where there's plenty of latent supply in the market. So watching candles very closely from that sort of 870 to 880 level. Until then, look, very possibly Paladin might be able to claw its way back into that zone. More likely, before that, even you might even see some of those supply side candles that will actually commence the next leg down from here. So in many ways, until I see the opposite, so fantastic long white candles, massive downward pointing shadows, probably also on some significant volume, higher peaks, higher troughs. Until I see those things, I have to assume the status quo, which is very much, as I've explained, a supply-side market. Now we're going to go to Silex Systems here, which is almost the complete opposite. And this is a stock I'd be interested in buying potentially at some stage. Now, double greens, that's the greatest giveaway of a demand-side market, short-term excess demand and growing long-term excess demand as well. In the price action, we're seeing high peaks and high troughs. not lower peaks and lower troughs. And we're seeing generally a predominance of demand-side candles. So we're seeing white candles here, not black candles. We're seeing lower shadows, or downward-pointing shadows, not upward-pointing shadows. And we're seeing gaps up and runs, not gaps down. So yes, Silex is certainly a company that I could investigate buying into. And for more information on when the candles and the price action and everything aligns, definitely check out my ChartWatch daily ASX scans lists, of which coincidentally Silex has been a feature chart several times over the last few weeks. Okay, so just giving you an idea of how my analysis that I'm showing you today actually is put into practice through my articles on Market Index. And coincidentally, Paladin has been on the downtrends list, and actually this one here as well, Boss Energy, has found itself on the downtrends list as well. And again, whether they're great companies or not, that's up to you to decide. I'm only interested in how the market's responding to the fundamentals. And I'm going to put to you the fundamentals here aren't as strong as potentially for Silex. They're probably more aligned with what's going on with Paladin, because we are seeing actually a very well-established long-term downtrend here, and the short-term trend after a bit of a rally there. And this rally occurred on the back of that China stimulus that was announced in September, and it's really appears to have petered out. Short-term trend has turned back down. The short-term trend ribbon you can see here is just almost perfectly telling us where that dynamic supply exists in the market, and candles are predominantly black, price action, lower peaks and lower troughs, and therefore with double peaks, poor price action and predominance of supply side candles, there's really nothing in this chart to tell me that I want to be looking at longs at this stage. Again, what can change? White candles, high peaks and higher troughs, getting above those trend ribbons and turning them into dynamic demand. So Boss Energy, I'll let you make of that what you will. We're stuck in the middle here on deep yellow, so we're very much an equilibrium market here. You can see the short-term trend ribbons, well, certainly the long-term one is amber. The short-term one actually has just swung back to a short-term downtrend, and it is actually impeding the price action to the upside. I think it's fair to say that the price action is lower peaks and lower troughs, and we do have, again, a predominance of very much supply-side candles here. That's the black ones and all the ones with the upward-pointing shadows. A little bit disturbing, actually. I know I said equilibrium before, but it's actually starting to look more like a supply-side market in long-term as well, because we've actually moved beneath that long-term trend ribbon, and we've actually just set here a peak beneath it as well, showing that it is, again, acting as dynamic supply. So let me just conclude here by saying equilibrium at best, but the signs don't look fantastic for deep yellow, unfortunately. Heading over to Bannerman, I'm going to go ditto. It's that equilibrium market, but in the process really of transitioning to a downtrend. Certainly the short-term trend is down, we know that, but the long-term trend with this lower peak here set beneath the long-term trend ribbon, you can just see sometimes it just works like clockwork. And then a second one here, really you have to argue that the balance of probability now is moving to a long-term supply-side market. Lower peaks and lower troughs again, black candles. I know I'm sounding like a broken record, but that should demonstrate the consistency in my approach. There's, for me, not a lot to see here for Bannerman. Moving over to Lotus, and we're seeing more established short and long-term downtrends here. Once again, price action and candles, nothing to get excited about. So I think we can start to move a little bit more quickly through this list, because hopefully you're getting your eye in for how to understand my technical analysis methodology. Double pinks here, horrendous price action. Certainly, look, this is the epitome of excess supply. This is a wall of supply of stock coming into the market in desperation. And you've got to think, why are people so desperate to get out? It's not because this is a fantastic company. It might be the opposite. And that selling is not hitting any demand at all. There is just no cash that wants to get in the way of this move. Is there no cash wanting to get in the way of this move because it's a good company or not so good company? I'll let you decide. Not a lot to go on here for Alligator Energy either. So I think we can move pretty quickly past this one. And once again, I'm going to be the biggest uranium bull and the biggest ASX uranium bull, as I was, to be fair, through much of this period here. go back, check my social media posts, check my posts on market index. When the trends were up, I was a bull, and it's just the way it works. The trends aren't up now, so why would I be a bull? Not much to look at here for Aura Energy. I'm, again, sorry if this is your favourite company, but I'm going to skip past it, and I'm not going to spend a whole lot of time on Elevate Uranium either, which gets us to our international players, and kicking off with Kazatomprom. This is listed on the London Stock Exchange, but is largely still majority owned by the Kazakhstan government. But for what it's worth, the biggest uranium producer in the world is showing a fairly decent long-term uptrend there, and also a short-term uptrend. So that is encouraging. But I think we can see from the price action, very, very overlapping and stuck within a fairly broad trading range here between sort of 34-ish on the bottom and sort of 44-ish at the top. It's an equilibrium market that is skewing towards signs of demand-side control there. Okay, so look, certainly not the worst chart we've seen, but not the best. Talking about the best, we get to Cameco, Canada's big uranium producer and the second largest uranium producer in the world, looking quite good with its double greens and short-term uptrend ribbon supporting the price as well. Price action is higher peaks and higher troughs. That's encouraging. Hey, nothing goes up in a straight line, so you can see a little bit of a pullback here, but we can also see how those lower peaks and lower troughs terminated at the dynamic demand of the short-term trend ribbon. And then you start to see those big white candles come in. So many times today I've said you're going to need to see big white candles. You're going to need to see long downward pointing shadows. And this is a great example of how demand starts to manifest itself again in the market. Look, interesting. I'm not saying it's plain sailing through here. You can see from that upper shadow, but seemingly getting a move on from here. What I like to do in these situations, so look, we've got double greens for me, we've got good price action, we've got a predominance of white candles, so that gets it on the list of stocks I could consider for longs. But I just want to have a look at the weekly chart and see if there's any overhead supply or major overhead supply points that this one will need to contend with. And to do that, I just flick out to the weekly chart. It's a simple way with one click to zoom out very quickly and see what's out there. And there's really nothing sinister in that sort of historical horizon, if that's even a phrase, to worry about there for me. So really, Cameco from here, all blue sky, and that actually makes this one even more attractive for me. And we're going to finish off our look at global uranium stocks with Nexgen Energy. And this one is actually listed across a few exchanges. So in Toronto, it's ticker code NXE, as it is on the NYSE in the US. And in Australia, it is NXG. So plenty of access to this one. Double greens again. So it's a candidate for long trades as far as I'm concerned. We can see that the short-term trend ribbon is supporting price. We can see high peaks and high troughs. We can see predominance of white candles. So ticking those boxes for me. We are seeing a little bit of trepidation. It's only a tiny bit in last night's candle coming in at this previous major point of supply here. And often we say that, there are a lot of people, again, caught in the market up around these levels. And all through this period, they're regretting that decision, and they're really hoping that the price will get back up to where they got in, so that they can get out at break even. So we're going to see a little bit of supply. It doesn't mean, not everybody thinks like that. Doesn't mean that that's where we're going to find the top forevermore. It just means we could see a little bit of excess supply coming at that level to cause the price to pause, and potentially last night's candle is telling us that. But everything else here, it looks good. We're heading into this level with a head of steam behind us, so I'm not too fussed about that historical point of supply. And again, looking at the weekly chart, there's really nothing above this. So if we can deal with this point of supply, then Nexgen Energy is highly prospective to move to higher and higher levels again. So that is the tour de ASX and global uranium there. I'm sorry if your favourite uranium stock wasn't on that list. Certainly hit me up on my socials, and I'm happy to look at charts for you in that regard. Moving to the uranium ETFs now, kicking off with the Sprott Uranium Miners ETF. We can see this one is kind of stuck in between some of those bearish looking charts and some of the really bullish looking charts, and it makes sense because it's an ETF of global miners. So it's really reflecting the fortunes and misfortunes of the stocks that we've looked at to this point. Look, positives about using an ETF to trade uranium stocks is you're getting all of the stocks. You're getting instant diversification, and you're getting instant exposure to a thematic. One of the drawbacks, as we've seen, is that not all uranium stocks are going to be booming at the same time. And potentially, if you've got a good model, maybe similar to the one we've talked about today, you can delve into sectors and pick those outperforming stocks. Okay, so I don't think we need to talk too long about this one. Trends aren't terrible, but they're not showing the positivity, the demand side impetus that I would like to see at this stage. The next one is more interesting. This is the Global X Uranium ETF, ticker code URA, and the first two are listed in the US, because this one has a much higher proportion of Cameco in it. We're talking about 24%, I think, in this one compared to URNM 17%. This one has a smaller exposure to, say, Paladin, which is one of those very poor-looking charts. So it's doing better. And maybe if you are thinking of getting a uranium ETF, therefore, this one has better technicals on that basis. They're the two US ones. If you're interested in what you can trade here on the ASX, I am, of course, based in Australia, if you couldn't tell from the accent. This is effectively the same ETF as the last one, so both run by Global X, and therefore they both have exactly the same constituent holdings, or proportionally so. So the charts of these two look essentially the same. I'll just flick between them, and if they are going to be different, it's going to be because of currency translations between the US and Australian dollars. So that is potentially for Australian investors a better option, given that it has a higher proportion of the better performing uranium stocks and a lower proportion of the poorer performing uranium stocks. And then we go to, coincidentally, URNM on Australia, but completely different provider to the Sprott one over there in the US. But pure coincidence, it has a similar sort of weighting to the URNM in the US, where it has just has less Cameco and a few more of the poorer ones, so stuck a little bit more in between. So look, in conclusion, if you want to follow my trend model, then either URA if you're in the US, or Atom if you're in Australia, is probably the better way to go out of those two. All right, back to the presentation again, and we'll just close off today's discussion with a quick look at how you can continue to follow along with my technical analysis on market index. The first place I think you really want to go if you've struggled with some of the jargon and terminology of my technical analysis method today is my technical analysis for beginners and ChartWatch Primer. And it is quite a detailed article on why you might want to use technical analysis in your work, and my brand of technical analysis, which is trend following, and the intricacies of my technical model, including candlesticks, price action, trends, and all the stuff we talked about before. The second place you might want to go on a daily basis, I do publish my daily technical analysis scan, so my favourite uptrends and favourite downtrends each day, and I also put in some feature charts, which I think are the strongest setups among them, and you can take these lists and put them into a watch list on your favourite technical analysis platform and play along at home. And finally, if you're on Twitter, or X as Mr. Musk likes to call it now, you can follow me. And I'm putting up regular updates on not just uranium stocks, but many other minerals stocks, including lithium, copper, iron ore, and just general economics and investing content. Also each day, of course, I put up my lithium charts, those charts you can't get anywhere else. So that brings us to the end of today's video. Thanks so much for watching. Stay tuned for new ChartWatch Market Insights videos. Make sure you hit the thumbs up button and the subscribe button in the post below to stay notified of all of my future video updates. Well, that's it for me today. Hopefully you enjoyed the presentation and maybe even learnt a little bit more about technical analysis. All the best for your trading and investing. Till we catch up again. Bye-bye for now.